Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Welcome to my podcast. Thank you for joining. You know, the other day I was talking about the difference between radio and the difference between, these podcasts. And I got a great example for it. And what I'm saying is that the problem is there's just too much noise in the financial markets because everyone can now have their own radio show, i.e. podcast. The problem was, to get on radio, you had two choices. One, if you're good enough, they would syndicate you. But most guys who are good don't want to be syndicated because they make more money syndicating themselves because they keep all the revenue. That's what I did for 25 years. And in radio, to get on a financial network, there was very few that would be on that network because the entry level was very tough. You had to pay to syndicate yourself. You got to buy the airtime, okay, and you got to pay anywhere from $30,000 to $50,000 a month, and that's why a lot of people syndicate because the stations keep all the revenue and they pay you a salary. But when all this changed over, and all the financial audience left radio and they moved over to, podcasting, you got so many people now that have their own financial show. Everybody's an expert. And the amount of garbage that's out there is incredible, the amount of noise. So you got to follow the money, not the noise. And I'm going to give you some examples, okay? Just crazy. So this one person said that that a major rating house said there would be a 40% drawdown on AI stocks in the next few months. Well, what a headline that is. That's a real grabber, right? I mean, that'll grab your attention. But when you get behind it, I mean, they never mentioned the name of the rating house. We did a thorough search. We couldn't find one rating house that came out with that. Maybe we missed it, but we did a thorough search. So we couldn't find that claim anywhere. So, but the person obviously got the point across to exaggerate. And that's the problem with this. You couldn't do that on radio. So this is because there's no entry barriers to this business today, there's too much exaggeration. And everybody's got to get that click. And and it's all about headlines and that headline, what a headline! 40% of stocks AI stocks will get wiped out. I mean that's that probably was exaggerated for clicks. I'm sure it was, but there's no question. Everybody is warning. I warned, okay, that this is feeling like 2001, like we're going to have a crash, but we don't have the signs right now that we're going to have this crash. It just is not there. I wish it was, because we make a lot more money, shorting stocks than you ever make going long, because number one, they go down 10 times faster. But everybody's warning. It's not a secret that a crash is coming. We got overvaluation. I mean, the valuation is stretched, prices are stretched. We have concentration risk. Everybody's buying the same stocks. And AI, we have an AI-related CapEx bubble. But again, that's a real threat right there. And again, no one's, publishing the specific crash as to percentages. I mean, we didn't find that anywhere, as I said. There's nowhere. But anyways, so just think about it for a moment. So that's a headline that is, it's an eye catcher, and we all know this market's going to crash at some point, but again, we couldn't find one house that was saying this. So people will react and they'll get into the wrong stocks. Now, AI valuations are stressed. We know that. NVIDIA, Broadcom, you kidding me? AMD, and go on and on, are all priced to trade for perfection, for God's sakes. AI, CapEx, is exploding faster than the revenues, than the revenue stream. How long can they do that? And this is nuts. And we have supply constraints. That's another big problem. And I mean, you can go on, and again, and the risk of concentration, you got everybody in the same 10 stocks. And by the way, when they mention this headline, they're saying we're going to have a crash within the next, 90 days. It's going to take down 40%, and it's going to be just like 2008. It's going to rival 2008. No, it's not going to rival 2008. What are you, nuts? 2008 was a credit collapse. Banks failed. Liquidity froze. And the global financial system totally seized up. What do you mean, like 2008? This has nothing to do with 2008. AI is a valuation bubble, not a credit bubble. 2008 was a credit bubble. But these people were saying how, oh, it's just like 2008. No, it's not. It's just not. So, and again, here's another one that was a lot of noise. And you can't get across, you can't, if you do this on radio, and I've been on radio for over 25, almost 28 years, you can't get away with that on radio. And again, there's more noise. Here's a bunch of BS. Manufacturing will cause an entire economy to collapse. Really? Okay. Are you kidding? Manufacturing, think about it, is only about 11% of our GDP, for God's sakes. So even if manufacturing contracts, it's not going to be the entire economy like they want us to believe, right? And then, again, services are 70% of our U.S. economy. We're a service-driven economy, not manufacturing. It's not factory-driven. It's service-driven. So again, healthcare, finance, tech, retail, transportation, entertainment, business services. That's the engine. That's our economic engine. And they're doing well. So this little piece that we're going to get, the whole economy is going to explode. We're going to be in breadlines with manufacturing. There's only a little tiny piece that's part of the economy. So again, here we are, more exaggeration. So when you have these jibber jabbers out there every day and all this noise, you got to learn not to follow that noise. Okay? And here's another thing that would be helpful, and I talked about this today with my members, that, you know, what you have to do today is really, you gotta protect yourself. And there's a certain, you can have a certain checklist that will help you do that, okay? And I got some notes here for you. I'm going to pull them out here for you. And by the way, we're going to start taking questions and answers starting next week. We've been saying we're going to do it. We've been putting it off because we've had some other stuff we had to do. But we're going to do that, okay? So that the first 15 minutes of the show will be commentary. The second 15 minutes will let you, just ask us a question. We'll be happy to answer it. So when you want to know what's going on, with the first place you go to is the yields, because rising yields, okay, that means your bond prices are dropping. And the bond market tells you what the market's going to do, okay? And it tells you if you have yields that are going up, that's really bad for stocks. So anyone knows that. But that's a way to check out. I wonder what the market's going to do. Remember, the market's forward-looking, so you've got avenues to go to research instead of listening to this damn noise, Okay, now, so again, when you have rising yields, the other thing you have is rising rates, deficit worries. You have inflation fears, tariff fears. I mean, look what's going on with Trump. It's back on the table now. First he said, no, I'm not going to hit the 8 NATO nations with a tariff. He took it off. He said, I'm going to cancel it, but he never took it off the table. He's talking about it again. So we have all this confusion. But when you have rising yields, there's no confusion. That's not good for stocks. Not good for stocks. And it only occurs in when we have strong economic growth. Now, declining yields, obviously, that's better. But the other place to go and look at what's going on is credit spreads. Because again, the yields tell you, if the yields are going up, there's a big warning there. The other place is our finance. Finance is the heart, is the beat, is the blood, and the heart of the market. So you go look at credit spreads, and you hear them throwing around credit spreads all day long, right? They love that word, credit spreads. Aren't I smart? Credit spreads. Credit spreads are nothing, okay? But it's a great instrument because it's a great tool. Because when you have the spread between the 10-year Treasury and the corporate bond, okay? So you have the 10-year Treasury, you have the corporate bond. And the difference between the two, okay, if it's, let's say between zero, if not, right now, if I had the credit spreads, and I haven't checked today, but let's say the credit spreads right now are about 30 basis points, okay? So that means it's tight. So that means that anything 50 or over is wide. You don't want that. You want to stay tight, because when it's like 30, 40, 10, that's even better. The banks feel safe in lending. So when you check the credit spreads, all you got to do is check, again, what's the 10-year Treasury, okay, and what are the yields on the 10-year corporate bond. And when you, I mean, it's so easy, and then you just look and say, oh, you can tell, okay, if the spread between the two is under 50, then you're going to be okay. The banks, the closer to zero, the banks feel more secure in lending, okay? More secure in lending. So that's a great place to also look, and you can ascertain what's going on, okay? So the credit spreads are a great place to look. The bond market, the yields, I mean, it's a great place to look. So you got places to go to identify if what you're hearing is a bunch of nonsense, okay? And so I just don't want to leave you over the weekend here. I want to show you some stocks and what's going on. Let's turn to my charts. When we had that 800-point rally, and then it flipped back, we had this 500-point rally. Remember, the only stocks that continue to do well are your gold stocks, your metals. They keep going up. Why do they keep going up? Because that's where people feel secure. The big institutions are dumping. The only reason, when we had that rally the other day, 500 plus, that was short covering. And it was the FOMOs, and it was the tourist traders who don't know what they're doing buying on dips. So we've been staying with our gold and our metals and our copper. We've been doing fantastic. And the only banks that are really doing well right now, okay, are the small regional banks. As far as the tech, Moo keeps going up as long as the credit spreads, okay, and the yields are in their favor. And Moo is just the leader. Because why? Moo's the only company that can sell memory. Imagine, that's like, this is nuts. That's like owning the only car dealership in the United States. So why do you think Moo goes up almost every day? You can't knock it down with a sledgehammer, because they're the only people that sell memory and broad bandwidth memory. And that's the whole glue that keeps this whole AI bubble together. And so in MU, first of all, there's 7 cracks in this whole AI rally that could break, and Moo itself has 4 cracks. But in the meantime, don't listen to the noise, follow the money. And so stay with that, stay with your, we've been staying with and doing really well with our the stocks that manufacture the equipment to sell to Micron and Intel that make chips. Those stocks, we've been doing terrific with those stocks as well. You know, like LRCX. So, you know, again, we have some real good stocks. As long as you stop listening to the noise, follow the money, we'll show you how to do it. philsgang.com. Stop listening to the noise. It's nuts, man.
Are you nuts?